At this time, I'd like to introduce Paul Georgy of Allendale to cover making a profit in today's market. Mr. Georgy is President and CEO of Allendale, Inc., a worldwide agricultural advisory and research firm. He's developed educational and trading seminars used around the United States and Canada. We hope that Paul can give you an edge in marketing and marketing decisions today. Please welcome Mr. Paul Georgy.
Thank you very much. Appreciate being here. I'm a little bit nervous about presenting my presentation after Mick's story here, but I'm afraid it's not quite as exciting, but we're going to give it a try. And I think what I want to show you today is some of the facts that we've got to deal with. Weather is certainly a variable, but the facts that we've got to deal with between now and a potential drought is real, and I think those are the things that we want to talk about here today. We want to talk about the investors in the business. What are their attitude toward commodities, and what kind of an impact does the U.S. dollar really have on grains and our world, the ability to export our grains to the world? We talk about crop rotation, and then we want to talk about marketing, and is deer in the headlights the best way to go? So as we move forward, one of the examples, and I think this chart depicts some of the impact of how investors look at the commodity markets right now. The light blue line there is the CRB index. The other line is the U.S. dollar. And as the U.S. dollar goes up, the CRB index is continuing to go down and continuing to make new lows. And the CRB index is a basket of commodities from gold, silver, crude, grains, livestock, all of these commodities. Those values continue to go down. So the investors are getting out, taking money away from that marketplace. So we've got to be concerned about that. And when does that trend change? It's certainly in a downtrend right now. So we've got to look at things of how much money is really being moved around. And one of the issues that we talk about on a daily basis and watch on a daily basis, combining the look of and what's happening in the grain market specifically as supply and demand and movement and so forth, we've got to look at the broad picture. How are the influences of outside markets affecting grain prices? And this chart's from Bloomberg. They show the amount of money that has come out of the broad-based commodity markets this last year in 2015. Somewhere close to $8.8 billion. A huge amount of money has come out, and this is based on the ETF market, the exchange-traded funds, where people buy a fund and it relates to the commodity market. So as they're buying a corn fund or a bond fund or whatever, the opposite happens, or that same thing happens in the futures market. So as they're buying these the exchange-traded funds, somebody has to come in and buy futures, and that's where you see the index funds on the weekly basis. That what are they doing, and why is it important to monitor those things? But this chart, I think, is probably the second most important chart that we've got to look at today. The bar to the right shows the amount of money that has come out of the broad-based ETFs and gone into the crude oil ETFs, which says that everybody is bullish or wanting to get long the crude oil. Because an ETF, you don't have margin calls. You just buy it, whatever value it is, and you're long the crude oil through these exchange-traded funds. And as you can see, the crude oil price on that line is continuing to go down while the money continues to pour in. So as we in this last 2 weeks, we've had more calls about what is going to happen and should I be buying crude oil. I want to buy crude oil. It's not even, they're not asking us what we think. They're just saying we want to buy crude oil. Well, look what's happening. You've got the boat already loaded. Everybody's looking at this market as a possible going back to $70, $80 a barrel. Well, it takes a couple factors to do that. Right now, we've got everybody already long the market via ETFs and via the index funds in the futures. What's going to drive the market higher? We're going to have fluctuations in crude oil. There's no question about that. Supply and demand will occur, but to look for a big run, it's going to be very difficult because you've already got the boat loaded. You don't have anybody there helping push the boat to higher prices. So that's one thing you've got to be aware of, and one thing that we monitor, and this same factor impacts the grain markets as well, your markets, and that's something that we monitor on a daily basis. Here's a chart that I think tells the story. The dotted blue line is the fund managed money positions in the corn market. We get a report every week from the CFTC. How much money, what is the net fund positions? They've got to report this to the CFTC on a weekly basis, and then they report it to the wires on Friday afternoon at 2:30. The red line is the cash price of corn. And then that little blue line across the top is index funds. So what has happened recently? You heard this last week. Well, the funds bought 71,000 contracts. They were net buyers of 71,000 contracts of corn. And you say, wow, that's got to be great. The corn market moved a lot. The corn market during that week went up 1 3/4 cents. So what happened? There was people getting out of the index funds. When you look at how that index fund line went down, and they were getting out of the futures, out of their net short positions in the futures contract. They also were running into headwinds by farmers selling, because as the market moves higher, farmers are loosening up grain storage, moving grain. So that's another factor that's causing the move here. And that last week was kind of unique, I believe, because when you look at that rally in the blue line versus the rally in the cash futures, we've went up about 20 cents from the lows to the highs. When the funds were the shortest to where we are today, we've gone up about 25 cents. And that's about right. As 100,000 contracts move in the funds, equates to about a 25-cent move in futures. And we've seen that a year ago. And look at, you look at the rallies in the corn, the bounces in the red line there, based on the movement in the futures, it's about a $1 rally. So we've got, and the takeaway from this whole thing is hope. Hope that we get some more buying by the funds, and they want to go long, and we get a weather scare, so to help push these prices higher, so you will have the opportunity to market your grain. And as we look at the big picture, the copper is a commodity it's an industrial commodity, and we look at what is the world, it kind of gives you a picture of what's the world situation really like. And in this case, the trend is down. Copper prices are down. The economies around the world are not robust. We're not getting all this excitement in the world that they're going to buy commodities. So we're watching copper on a daily basis to give us an indication when things are turning. And I think that's something to monitor, not necessarily trade or have direct indication of what might be happening in the corn market, but it gives us a feeling of what's the overall attitude as you try to decide when to market your grain. So what this is telling us, if you're using this as a marketing tool, you say, well, on rallies in the grain market, as long as the copper market's continuing to trend lower, maybe we should be sellers rather than buyers. Crude oil, we all know what that's happening there. North Dakota as a state is certainly involved in the crude oil business now. and things are changing, budgets are changing within the state because of the cheaper oil prices. But yet, as oil prices continue to get cheaper, or the oil prices continue to get cheaper, we continue to produce more. And we have greater supplies of crude oil. So how can we get so excited about buying crude for a huge rally when we have large supplies? It's not going to go away overnight. Here's another factor that we've got to be concerned about, and I apologize for the cough. I've been fighting that for about a month now, and we'll try to get through this thing. This is another factor that's a huge headwind for us in grain marketing, because we got to export some of our grain around the world, and that means we got to sell it, and we got to sell it at a cheap price or a competitive price. Well, when you look at this chart, you've got the blue line is the US dollar, the red line is the Brazilian real. As the dollar goes up, the real goes down, what happens? That makes the crops, the grains, and the exports out of Brazil, Argentina, and this, I'm using the real here just to give an example. The Argentina peso is the same, continues to go down. They've got the highest price, they got record high soybean prices and corn prices in South America now. And they're had record production. Why is that? Because of the exchange rate of the US dollar. The dollar continues to strengthen, their currency gets cheaper. Now, there's other problems by that, but the cost, the value of that soybean and grain coming out of South America to those farmers are the highest prices they've ever had because of the exchange rate. And what has that done to exports? As we look at this chart, corn, number one, and actually look up in the right-hand corner, is what you see right now, this year, we are 25% below a year ago levels. USDA says that we should be about 9% below a year ago levels. Soybeans, and this was done a couple weeks ago when I sent in the presentation, we were 11% behind. We've caught up. We're about where we should be, about 8% behind right now on soybeans because China continues to buy some beans from us. But wheat, we're still running way behind. And why is that happening? Because South America has, and Argentina specifically, has gotten rid of the export duties and taxes on corn and wheat, and therefore it has become tremendously competitive against the US dollar and the US farmer and the US grain prices. Now let's look at supply demand as well. I mean, I don't want to dwell on the supply demand so much because the reality there is we know we got a lot of corn. We know there's a lot of corn in the world, but when you look at this chart, this is the latest from the USDA. We've got 211.9 million metric tons of ending stocks of corn in the world. Record world ending stocks. So in order for us to get corn prices to go to these skyrocket prices of $6, $7, $8, like some people are talking, we're going to have to get rid of some of this supply that we've got. When you look back at 2012, we had 125 million metric tons in the world. And a big part of that is China. China has got ending stocks of 114, nearly 115 million metric tons, over half of what the world ending stocks is. And what's happening in China right now, the Chinese government says, well, what they've done is support the Chinese producer, and by doing that, they've continued to outproduce their demand. Their goal is to be self-sufficient in corn production and grain production. And they're working at it and doing a good job at it. They've got 115 million ending stocks. They're realizing that the government has to do something about these huge ending stocks, so they try to lower the domestic price. But the problem that they've got in China right now is that the imported price of grain is cheaper than the domestic price of grain. And why wouldn't the end users in China continue to buy all this corn? And they're buying corn from the Ukraine, they're buying DDGs from the United States, and that's more of a protein substitute as well. So they're trying to figure out ways in order to supplement the producer, to get him to produce as much corn as he possibly can, and yet not hurt the price. Well, we know how that works in the United States when you got government involved in controlling price. It doesn't work all that well. A big part of Chinese demand is their hog production. They've got the largest hog herd in the world, and they've slipped back here in recent years because of profitability. The hog numbers have gone down, sow numbers have gone down, production has gone down. They reduced the demand for protein. So this year, it looks like they've increased their sow herd again, or in the process of increasing their hog herd. And what does that mean? They need more protein. And therefore, that's why we see the demand for soybean meal. We see demand for DDGs, because they've got to import all of their protein. Their focus is on producing corn, wheat, rice, and the protein they're going to buy. They produce very small amounts of soybeans compared to what they need. So they're going to import as much protein as they possibly can. Here's a graph on the Chinese meal consumption. As you can see, from the lower left to the upper right, it's kind of a straight line. There's not very many bumps in there where they've reduced their meal consumption, continuing to increase their demand over the years. And we see no reason for that to stop. As this 1.4 billion people, they want to continue to have better diets, higher protein diets, and as they demand that, they need to produce more, and one of their best sources of protein is meat and is pork. The soybean imports continue to grow, and as this chart gives you an example, you look at the bottom, the orange area. Excuse me. In the orange area, you can see where that's the U.S. part of the soybean imports into China. We've stabilized or actually gone down a little bit, but the major part is coming from other sources, and this is South America. So they're going to continue to buy as long as they can get soybeans from that area. Another problem, headwind that we have in our grain supply around the world and competition for our U.S. markets is Argentina. With the new president they've just elected down there at the beginning of the year, what he's done is gotten rid of the taxes on corn and wheat and reduced the taxes, I believe, 5% on soybeans, but there's still about a 30% export tax on soybeans that he plans on reducing over the next several years. But the line here shows you what the Argentina farmer holds in soybeans. The soybean is a huge amount. They own about 30 million metric tons that they've got in storage that can come on the market, which is going to be a huge competition for U.S. Markets and U.S. sales, especially with the exchange rate the way it is. The corn, not a big deal. They've got about 3 million metric tons of corn in Argentina that can be sold, and they've been doing that. They've been selling a tremendous amount of corn here recently once this tax came off. Now, some supportive factors from that is they've moved a lot of corn. Now, basis has gone up on South America ports because the farmers are seeing that, well, the dollar has gone up, the peso has gone down, the price has gone up, so now they're getting a little greedy, hanging on for a little more. And that's helping the basis, which is actually helping direct some potential exports of U.S. corn, because now we're competitive again with the Argentina supply. Here's a chart that I think you'd take note of, and you say, well, U.S. is a big exporter. We export a lot of beans, and we export a lot of corn, but what about soybean meal? Argentina is the #1 exporter of soybean meal in the world. Brazil, #2. Argentina is the #1 exporter of soybean oil in the world. So what they've done down there recently is that they have taken, or the president said, we're going to allow imports of soybeans, which they haven't done in many years. He says, we're going to allow imports of soybeans for processing. He knows that he can move that grain through his country and be competitive to keep his processing plants operating and going strong. So another headwind, because he can be buying the soybeans from other countries in that South American area. Argentina can, who they've got the processes to be able to export this stuff. Here's a chart that I think, when I look at this, and this is a concerning factor, and one of those reasons that I worry about what will happen in the next 6 to 8 weeks. This is a supply of corn stocks of corn that was released by USDA on December 1, as of December 1. It shows that the corn owned by farmers is the dark green line. The light green line is the corn that is not stored on the farm. And when you look at the green line, you say, well, it's not the highest, the dark green line. You say it's not the highest amount, but it's the third largest amount, and it's coming off of some very big numbers. We've got over almost 7 billion bushel of corn on the farm as of this date. And another big concern that I've got in the off-farm storage is that our customers are telling us that there's a lot of corn that has been moved at the end of the year because of needing some cash to operate on. So what they've done is they've moved the corn off the farm, put it into the deferred payments, basis contracts, which were all wise things to do, but they're basis contracts and deferred payments off of the March futures contract. So what does that mean? That means that we've got a huge wall ahead of us, because what it's telling us is that the grain that has been sold on basis contracts and forward or deferred payments has got to be priced by the first notice day of the March contract, which means the end of February. And and most of these contracts are long the market, so that means they were going to be selling the market. So you got to be careful of that. That's why we think that the price outlook here in the next couple weeks could be negative more than positive, because there's this corn that's going to be priced. So if you've got corn that you need to move, and you need to move it before the 1st of March, it's probably not a good thing to wait until the end of February to do that. Soybeans, we got the same situation. We're near the all-time highs, the largest amount of soybeans on the farm since 2006. Near the record amount of corn or soybeans total. Not a bullish situation when we look at what South America has to offer us and offer the world buyers. Crush margins are not real great right now here in the U.S., so we're seeing some basis back down there. So we've got some situations there that we need to deal with. When you look at the percentages, you might be able to see this in the back, but we're sitting at about normal percentage, near the highs on soybeans at 48% of the crop, where in corn we're at 61%. So we're normal when it comes to the amount of corn there. Looking at the adjustments, the USDA's got a report coming out here next week that the stocks to usage probably is going to go up because they're probably going to have to lower the export numbers because we're not exporting as much as we need to, so the government could do that. The ethanol number, they could actually increase that because we're running at a very high pace there. A lot of ethanol is being exported, and again, like oil, we're building stocks in ethanol, which may not be a bullish situation down the road. Soybeans, same kind of a situation there. We expect these stock numbers to increase. The crush number is likely to be decreased, maybe by 20 million bushel, because we're not crushing soybeans at the pace that we need to in order to meet the USDA's projections. Let's back up here a second. We just want to talk about the new crop projections here and how many acres, what's going to happen. We haven't got any numbers, and we're not going to get any numbers from USDA for a while. At the end of February, when they have their outlook meeting in Washington, we'll get some preliminary numbers from USDA. But what we're hearing from producers and bankers right now is that they are going to plant corn and stay in rotation. Rotation is the #1 factor that controls the amount of corn and soybeans that planted. They planted a lot of beans last year in the heart of the Corn Belt, Illinois, Indiana, and Iowa. They're going to come back in and plant corn this year, and they can get by with a little less fertilizer that way. And again, as Mixed knows, it's going to be weather that's going to determine really how many acres we're going to plant, because if they've got the corn planters running and the weather and the field conditions are good, we're going to plant a lot of corn and plant a little more corn. So we're going to have a little less soybeans, more corn. We're expecting that we could see corn acres in the 90 million acre category, and soybeans, they could increase as well, maybe up to 83 million acres, because we'll have some extra land. Hopefully the prevent planting acres, we should see some of that come back into production. Ending stocks, just a comparison here of what the ending stocks look like compared to 2009. Many are trying to compare prices to 2009. It's very likely we could see continue increases in the ending stocks of U.S. corn as we move forward here for a few more months. So now to the important thing of what should we do? Deer in the headlight marketing strategy, and that's what I get from a lot of our customers right now. They think the market's going to go up. Actually, they know the market's got to go up. So that's the things that I face and my people face every day. It's got to go up. Why would you want to sell it? It's got to go up. Well, gotta doesn't really work in the marketing aspect of it. So you really need a plan, and you need to take some action. And here's an example, and to lay some credence to what Mick had talked about a while ago. So far this year, we've got a 19.25 cent trading range in December corn. And looking at this chart, it gives you the ranges that we've had over the past several years. Last year, we had a 98 cent trading range in corn. So and that was on the lower end of the range. So if we don't believe that we'll have a range like we had in 2008 or even 2012. But if we got a $1 to $1.50 range in corn, that would be pretty nice, wouldn't it? Be really nice. So there's opportunity and there's hope that we will get an increase in range. But what are you going to do about it in the meantime? And do we have enough, not financial stability, do we have enough mental stability to be able to take that range and wait until the price rallies? If we get El Nino and it hits in August, you've got 2015 corn that you got to market. Can you withstand a $3.08, 18-cent price in the meantime before we go and get a $1.50 rally? That takes us back to $4.50. The problem that I see and the biggest concern that I have for you, the producers, is what do you do about the mental stability? You've got to be able to, and I'll tell you a story about a customer of ours right before Christmas. He's an Iowa farmer. He's got 600,000 bushel of corn that he has unpriced. And right before Christmas, corn prices were pretty good. He went in and visited his banker. He's happy. He called us up. He's on his way to Arizona with the family. I'm going to take a 2-week vacation. Happier than a lark. Bank's going to give me money. He hasn't signed any papers, but the bank's going to give him the money for next year to plant the crop. Well, he comes back first of the year, the first week in January, he calls again. Not so much in a good mood. He had a good vacation, but prices of corn have gone down 10 or 15 cents, I think it was at the time. So if you look at that loss, he says, oh my gosh, I've just lost $100,000 in equity. I'm not so sure that the bank is going to give me the money. Now he starts worrying. And some of you might be in that same situation. So what is the plan? We've got to have a plan for our emotional stability as well as our financial stability. Because if the market goes down instead of goes up first, can we take it? And that's the point that I'm trying to look at here. Our strategy for nearby corn, I'm going to give you basically one strategy for corn and soybeans because there's 1,000 strategies. Everybody in this room has probably got a different strategy that we can work on this year. But the key is that we have to take action on our strategy, not just sit here and wait like that deer in the headlight. There's some people out there that are talking, well, I wouldn't do anything. I just sit and wait, let it go up. That's great if it goes up. What if it goes down? Then we got a problem. And he don't have a problem, you got a problem. So we got to take some action. So what we're looking at here in this corn market, we've been in a trading range for a long time, basically throughout the entire year, between 350 and 450 in the nearby corn contracts. So our goal here is if we get anywhere near the $3.90 to $4 area, we would suggest buying puts or selling cash. And the reason we would buy puts, and this is a question that we get asked so many times, is why you want to do the options. Why don't you just sell it? Why don't you just buy it, go in the futures? Well, how deep are your margin accounts? How much money do you want to send in margin? So we're trying to control our margin cost. So we're buying puts. If the market goes down to the lower end of the range, and many are technical guys, if we take out 350 on the downside, we probably go to 318. That's what a lot of analysts have been looking at, and we think it's very possible that we could go there. So that's what we did back in 2014. And we're actually going to have bigger ending stocks this year than we had then. This is our price outlook for new crop corn. And I want to say, in our price outlook, last year we had, we got to pat ourselves on the back. I don't want to have you call the ambulance because I broke my arm here patting myself on the back, but we did hit the trend very well. We were in the summertime and everybody was saying it's got to go down, and our price projection says we're going to go up $1, and we did. And this year, I think the roadmap isn't quite as clear, but we're going to have movement in this thing. 350 right now should hold us because we've got a balance. The producers can still hold on and not move the grain when it gets to the lows, because that's what usually makes the low, is when the farmers in central Illinois open their bin doors and say, I can't take it anymore, I'm going to get rid of this stuff. So when they do that, that's when we make the lows. Right now, everybody's balanced. We got the end user happy, he's got a belly full, the farmer's got the bins full, markets go up a little bit, farmer sells a little bit, markets go down, the end user buys a little bit, and everybody's happy. But what happens when the end of February comes around? What happens when you go into the banker and the banker says, you got to generate some cash. I'm not going to give you all this money. So that means you got to sell. So later on in the year, we could see prices work lower. And in the old crop, more so, and the new crop is going to follow along, probably less so because of weather forecasts and talk about drought, and so it's got a potential to go up. We're looking for prices to move higher into the summer, and then we probably tail off because we happen to think right now, until we get proof that we got a drought, you got to assume we got a normal crop. And if we got a normal crop, we're not going to $5. We're not going to $6. We're going to be lucky if we can get to $4.50, $4.20 maybe. So our strategy is, our first strategy is, as this market moves down here, let's buy some calls. You're going to have to take bits and pieces out of the market right now. You can't, there's not going to be a home run this year, I don't think. Last year we had a home run. When the market went up, we sold it. Market went down. Everybody's happy that did it. So what we're doing right now is we would say, let's put orders in to buy September short-dated option calls for about 10 cents. And then as the market rallies into the summertime, what we want to do is the SEP 2 of the program. We're going to sell or buy puts, $4.20 puts, and sell $4.50 calls. What that does for you, if you get the calls bought first, then as the market goes up, you got a floor at $4.20, and if the market keeps on going up, you've got your cash to sell, and you've got your margin call covered because you got that call protecting that upside. And you got margin call reduced, not completely covered, but you're going to reduce your margin call. So you can be protected at $4.20 where you know you can make money, and you've got the door open to make more money as the market goes up. So to recap that, for old crop, we would just move that cash anywhere near July futures at 410, and we're working our way up there slowly. We might get there. I don't know. My biggest concern to you and what I tell my customers is, what if we don't get there? We should be buying some really cheap puts right now. And if we go into the end of February and the market goes down, let's buy some May puts or some April serial options and buy 350s in May. I don't know what they're even worth, but let's say you buy them, you buy a put for 5 cents. And you do it not on 10,000 bushel. You got to do it on your crop. Do it, what do you got in the bin? What do you don't have priced? 5 cents. I can risk that. Because if the market goes down to 318, I'm going to be feeling pretty darn good that I did this. If the market goes up 10, 20, 30 cents, I can feel pretty good that I'm going to make that much money because I didn't react and didn't sell. So that we would buy puts and sell calls against it if we got anywhere above this $4 range. New crop, now you guys with cell phones, you might want to take a picture of this. You certainly can. So you can take it home and read it. We give you a chance to do that. This is one strategy that we're looking at. We're buying those short-dated September calls, and we're doing that at about 10 cents. We're placing orders to buy the 420 put, sell the 450 call at even money. And again, question that I get all the time is, well, why don't you do it in futures? Why are you doing it in options? Managing your money, managing the margin risk that you have. Because you don't want those huge margin calls. I know that. I've worked in this business for 33 years. And one thing farmers don't want to do, especially in a year when finances are tight, you've got to control those things. Soybeans, we got opportunities there as well this year. And this just shows you what the price range has been. 25-cent price range in soybeans this year, when average is probably somewhere around $2, $1.95 to $2. But if we go from $8 to 10, or we go from $8.50 to $10.50, we're probably not going to get the $12 or $13 price that everybody's looking at. You've got to have strategies and put your orders in, because those prices could happen very, very quickly. If the funds start moving money out and prices go up, and they're going to go up quickly, and by the time you react and you talk about it, you say, well, I think I might do that. Well, then I'm going to put it up the 5-cent syndrome, 5 cents above the market all the time, where you never get anything sold. So put it in. Soybeans in a range from 8 to 10.50. We think that's where they're going to be for a while. We're looking for a weather rally late in the old crop, but in the meantime, we could see some pretty depressed prices. The only thing we got going for us right now is a potential weather problem. We're in a demand-driven market, and in demand-driven markets, the markets go up and then they go down because the buyer's got control. And he's going to wait to buy his next batch until he gets down to a level that he wants to buy again. So we're going to need some supply disruptions. And the next thing we've got, South America doesn't look like they're going to give us any supply disruptions. So we're going to have to wait for the North American crop. And that's going to be weather. We're going to have a weather rally. If it's not a drought, it's going to be too wet, too hot, too dry, too cold. You got 4 chances. And we're going to have some of that, guaranteed. November beans, buy some puts down here, or buy calls again, is what we're looking at. Take a picture of this as well. We want to re-own beans. If you're selling beans down here, we think you can re-own them because there is a good chance. Is the bean market, we're going to expand our range, okay? So if we're going to expand the range, is the market going to go down $2 from here? I don't think so. I think we got a pretty good chance that that's not going to happen. Can it go up $2 from here? It could. It could go up $1.50 and down 50 cents. There's a lot of different alternatives on which way we could go. New crop, we'd buy some short-dated July calls, 9-10 calls for 15 cents. And then if the market rallies, we'd buy November puts at 10.20 and sell 10.80 calls. And try to do that at 5 cents or close to even money as you can. Again, trying to reduce your margin and get some protection on. And then you still got your crop. If you think it might be dry, might be causing it to go up, and you're concerned about not getting a crop. So we've got to monitor that very closely. So in summary, what are we going to do this year? We're going to watch for money flow in the market, extremely important. We're going to watch for demand changes, because if demand all of a sudden gets hot, it's going to cause prices to go up. Look for potential supply changes. That's going to be the big factor. And then what we've got to do is we've got to take action. You can't just sit there and wait for the herd to move. If the herd's going to move, it's going to be too late. So you've got to do it before that time. So with that, there's tremendous amount of opportunities this year. I think you've got to be focused on it. And with that, I thank you and have a very profitable 2016. So if you got any questions, I'll be happy to answer them. No questions? I answered every question that you had. All right. Well, that's good. Thank you very much.